The United States government is now spending more on interest payments for its debt than it spends on its entire military budget, nearly $970 billion every year. And that is only the interest, not the debt itself. It is simply the cost of borrowing money that was already spent long ago. What makes this even more serious is that this figure keeps rising automatically day after day. Now here is where the situation becomes truly unsettling. Marco Mind, the investor known for building the world's largest hedge fund by anticipating major economic turning points before most people see them, has now made it clear publicly that this is no longer just a warning about some distant future risk. In his view, the debt cycle has already started to break apart. The global order has already begun to shift, and the overwhelming majority of people still do not understand what that means for their savings, their investments, or their long-term financial security. In this video, we are going to go through the exact framework Marco Mind uses to explain why this outcome was always going to happen. We will look at where we currently stand in the cycle, what he believes comes next, and the specific actions he suggests taking before the rest of the world finally catches on. Because the reality is simple. By the time a financial transformation becomes obvious to everyone, the opportunity to prepare for it is usually already gone. And what is coming next is the part almost nobody is ready for. To understand why Marco Mind is saying these things right now, you first need to understand the one framework that changes the way you see almost everything happening in the world today. He calls it the big debt cycle. And what makes this framework so different from most other economic theories is that it is not built on opinion and it is not driven by ideology. It is built on hard evidence, 5 centuries of it. Marco Mind and his team at Bridgewater spent decades examining economic history across every major dominant power ever recorded. Not only the United States, but also the Dutch Empire, the British Empire, the Roman Empire, the Ming Dynasty, and every civilization that once held the kind of position America holds today. And across all of them, even though they were separated by centuries, geography, political systems, cultures, and technology, they discovered the exact same recurring pattern. Every empire, every reserve currency, every dominant power in recorded history followed the same path, no exceptions. Here is how that path works. It always begins with a new world order. That new order usually emerges after a huge crisis, a war, a collapse, or a total reset of the previous system. Think about what happened after World War II. In 1944, at the Bretton Woods Conference, the US dollar was officially established as the world's reserve currency. America had the biggest economy, the strongest military, the highest productivity, and the most trusted institutions in the world. A new order had begun. From that starting point, the empire moves into a growth phase. Debt remains manageable. The currency is trusted around the globe. Living standards improve. Optimism runs high. For the United States, this period was roughly from the 1950s through the 1990s. For most people alive today, that era simply felt normal. Then comes the stage of peak prosperity. The currency becomes the world's benchmark. Financial markets dominate globally. Military strength is unquestioned. Living standards reach their highest point. But here is the part almost nobody talks about because it is the part that stays invisible until it is far too late to reverse. Underneath all that prosperity, something begins to change quietly. Debt starts growing faster than income. Asset bubbles begin forming. The wealth gap starts widening. Political division intensifies. Trust in institutions begins to weaken. More and more people start feeling like the system is working against them instead of for them. Does that sound familiar? From there, conflict and disorder begin to emerge. Social unrest becomes more frequent. Rival nations begin challenging the dominant power. Trade tensions escalate. Money printing expands. And for the first time in decades, the currency starts facing genuine competition from alternatives. Eventually, the world order resets. This is the moment when the accumulated pressure of debt, money printing, inequality, and geopolitical rivalry becomes too heavy to sustain any longer. Governments are forced to restructure debt. Currencies are devalued to ease the burden. The global balance of power shifts in a fundamental way. And once the dust settles, a new cycle begins all over again. Every empire, every time, not one exception in 500 years of recorded history. So the real question is not whether this cycle applies to the United States. History already answers that. The real question is where exactly we are in that cycle right now and what the data suggests comes next, because the numbers tell a story that is extremely hard to ignore. Let's start with the debt, because the data here is staggering. The U.S. national debt is now approaching $38 trillion. Pause for a moment and really think about that. Not as some abstract number on a screen, but as something real. In the last fiscal year alone, the federal government paid about $970 billion just in interest on that debt, not the principal, not public programs, not services for citizens, just interest on money that was already borrowed and already spent. That amount is greater than the entire U.S. defense budget, larger than Medicaid, and bigger than almost every other item in the federal budget except Social Security. Now think about your own life for a second. You work, you save, and you try to set money aside for your future. But if the dollars you saved last year quietly buy 4% less this year, and then another 4% less the year after that, then after a decade, your savings have not actually grown. They have quietly shrunk. No one announced it. No headline told you your money was gone. No letter arrived in the mail explaining the loss. It simply faded away in the gap between what money is supposed to be worth and what it can actually buy. That is the exact process Marco Mind is describing, and it is already happening. Now here is the specific figure that explains why Marco Mind is sounding the alarm in 2026 in particular, rather than 2 years earlier. Interest costs as a share of the total U.S. economy have now climbed above 3.2% of GDP. That is higher than the previous all-time record set in 1991. And the Congressional Budget Office, the nonpartisan fiscal watchdog of the United States, projects that this number will rise to 4.6% by 2036. Not if a major crisis occurs. That projection assumes conditions remain relatively stable. By 2036, interest payments on the existing debt are expected to nearly double, reaching around $2.1 trillion every single year. Why does that matter so much? Because once a country's interest burden reaches this kind of level, the math becomes nearly impossible. You cannot grow your way out of debt fast enough. You cannot slash spending deeply enough without triggering a recession that reduces the very tax revenue needed to service the debt. Then you cannot raise taxes enough without pushing capital and investment toward other countries. So what do governments do when they are backed into that corner? They print money. They have done it in every comparable case throughout recorded history. Every time, no exception. And Marco Mind said it directly in January 2026. We're increasingly buying our own money. That's the real lesson here. In plain language, the U.S. government is effectively creating new dollars to pay interest on dollars it borrowed in the past, and every new dollar created quietly weakens the value of every dollar already in circulation. This is not inflation in the simple everyday sense of grocery prices going up. This is the slow and systematic devaluation of a currency over time. And that is how nearly every major debt crisis in history has ultimately been resolved. But here is where things become even more dangerous. The biggest threat right now is not just coming from inside the United States, it is also unfolding quietly through decisions being made in Beijing, Riyadh, Tokyo, and in central banks across dozens of countries that most ordinary people never even think about. And by the time the public realizes what is happening, the window to act may already be gone. When most people hear the words debt crisis, they imagine something like 2008. Banks collapsing, emergency press conferences in the middle of the night, markets plunging 40% in a matter of weeks, something dramatic and impossible to miss. But Marco Mind says what is happening right now is fundamentally different. It is quieter, and it is more permanent. He calls it a capital war, and it is already underway. Here is how it works. For the last 80 years, U.S. Treasury bonds have been the foundation of global finance. Whenever foreign governments, central banks, sovereign wealth funds, and major institutions needed a safe place to store huge sums of money, they bought U.S. debt. That gave the United States an extraordinary advantage that most Americans have never fully appreciated: the ability to borrow cheaply and endlessly because worldwide demand for its debt was effectively guaranteed. That guarantee is now beginning to weaken. And here is the specific signal Marco Mind pointed to, one that most mainstream analysts still are not treating with the seriousness it deserves. Central banks around the world have been quietly but steadily reducing their holdings of U.S. Treasuries. At the same time, gold purchases by global central banks have hit record levels for 3 years in a row. These are not retail investors panicking because of scary headlines. These are reserve managers, people whose job is to preserve national wealth over the long term, making structural decisions about what to hold for the next several decades. When those managers move away from U.S. Treasuries and toward gold at this scale and for this long, that is not a temporary sentiment trade. That is a structural judgment about the long-term reliability of the U.S. dollar as a store of value. Marco Mind said it plainly. There's a supply and demand issue. You cannot ignore the possibility that maybe there's not the same inclination to buy U.S. debt. And when the world buys less U.S. debt, the United States faces only two real choices: either raise interest rates high enough to attract buyers again, which makes the debt spiral far worse, or print money to fill the gap itself. Both roads lead to the same place: a dollar that is worth less tomorrow than it is today. Now add the geopolitical dimension that Marco Mind specifically emphasized. Capital wars almost always happen before military wars. Countries do not begin with weapons. They begin by freezing assets, imposing sanctions, restricting banking access, and cutting off trade. The freezing of Russia's foreign currency reserves in 2022 was a perfect example of this. Hundreds of billions of dollars in assets were suddenly frozen and made inaccessible with just a few keystrokes. Marco Mind specifically pointed to that event as a warning sign to every government in the world that holds large reserves in another country's currency. The message was simple: if political conditions change, your reserves can disappear overnight, not because of market losses, but because of a decision made by someone else. The global reaction to that message has been quiet but unmistakable. A steady, deliberate movement away from dollar-denominated reserves. Not all at once, not in dramatic headlines, just month after month through quiet portfolio decisions being made behind closed doors in ministries and central banks around the world. That is the capital war. It has no single obvious start date, no dramatic bell ringing to announce that it began, but it is reshaping the financial system in real time and more permanently than almost anything shown in the daily news cycle. Now you understand the cycle. You understand the capital war that is already happening beneath the surface. But here is the part Marco Mind said most people are going to completely miss. And it is the part that directly determines whether you come through this transition ahead of the curve or badly behind it. Because Marco Mind does not describe the future as one single predetermined catastrophe. He describes it as a fork in the road with three very different possible outcomes. And understanding which path we are taking changes everything about how you should position yourself financially. The first path is what he calls the disorderly decline. This is the scenario where nothing meaningful changes at the policy level. Deficits keep growing. Political deadlock prevents serious fiscal reform. Debt continues climbing until global markets begin to truly question whether the problem will ever be addressed in a serious way. In that scenario, the government is left with essentially one main tool: currency devaluation. Not a sudden public announcement, not some dramatic official statement, just a slow and relentless creation of new money that reduces the real value of the debt while also reducing the real value of every dollar held by every ordinary person who spent their whole life saving responsibly. Long-term bondholders, the people who did exactly what they were told was safe, suffer heavy losses in real purchasing power. The dollar gradually and then suddenly loses its reserve currency status. Social tensions inside the country intensify as people feel their financial pressure increasing without fully understanding the cause. Marco Mind does not say this outcome is guaranteed, but he does describe it as the path of least political resistance. And across 500 years of history, it is the path most empires in this position have eventually taken, because the alternative demands short-term pain that almost no politician wants to accept responsibility for. The second path is the managed transition. This path requires something that has been largely missing from major democracies for quite some time: genuine long-term thinking about fiscal policy that goes beyond the next election. Marco Mind has outlined what he calls the 3% solution. That means reducing the federal deficit by roughly 3% of GDP through a mix of disciplined spending and carefully structured revenue adjustments. This does not erase the debt overnight. Nothing can do that, but it stabilizes the direction of the problem. And more importantly, it sends a crucial signal to global markets that the United States is taking its fiscal position seriously instead of endlessly postponing the consequences. The trade-off here is real, and Marco Mind does not pretend otherwise. Growth slows in the short term. Some spending is constrained. Certain programs are reformed in ways that create temporary discomfort, but a disorderly collapse in global confidence toward U.S. debt would be far more destructive for ordinary people than any period of near-term austerity. In this scenario, the United States remains one of the world's leading powers, though no longer the single dominant power. The world does not work that way anymore, but it can still remain a stable, respected, influential major player in a more multipolar global order. And then there is the third path, renewal. Think about what happened to agricultural productivity after the mechanical tractor was introduced. Suddenly, one farmer could accomplish what previously required 10. Output surged, cost collapsed, food became available to hundreds of millions who previously could not afford it. A limitation that had shaped human civilization for thousands of years suddenly began to dissolve. If artificial intelligence can produce even a portion of the productivity gains people are projecting across medicine, manufacturing, energy, logistics, and scientific research all at once, then the entire economic equation behind the debt crisis changes. Government revenue could rise significantly without increasing tax rates. The debt path could stabilize through real productivity gains instead of painful austerity. Living standards could improve even while fiscal discipline is restored. Marco Mind says this path is genuinely possible, but he also says it requires one condition that has not yet been met. The gains must spread across the broader economy instead of becoming concentrated even further among the people who already own most of the assets benefiting from automation. If AI mainly amplifies the existing concentration of wealth, then it will accelerate one of the main forces causing this breakdown instead of fixing it. Renewal is possible. It is not the base case, but it is incredibly important that people understand it, because the policy choices being made right now and in the next few years will largely decide which direction this goes. Now let's get very specific about what all of this means for your money, because after everything we have discussed, the cycle, the debt burden, the capital war, and the three possible futures, what does Marco Mind actually recommend for individuals trying to preserve and grow wealth through this transition? First and most importantly, stop thinking about safe investments the way you were traditionally taught. For most of the last century, the safe asset seemed obvious: government bonds. You lend money to the government. They pay you a fixed rate of interest. You get your principal back on schedule. Stable, predictable, safe. Marco Mind argues that this old framing has become genuinely dangerous, not because government bonds are guaranteed to default in a legal sense, but because the real return on those bonds, once you account for loss of purchasing power, becomes negative when governments are monetizing their own debt. You are being repaid in dollars that are worth less than the dollars you originally lent. The nominal return might look acceptable on paper, but the real return is a loss. He has been very direct about this. At this stage in the debt cycle, the reward for lending to the government is usually not enough to compensate for the erosion of purchasing power that comes with it. So if not bonds, then what? Assets that governments cannot simply create out of thin air. Gold is the clearest and most consistent example Marco Mind points to, not because it produces income, not because it operates like a business, but because it has preserved purchasing power through currency declines, empire collapses, and monetary resets for thousands of years. A central bank cannot create it with a policy decision. A government cannot inflate it away with the push of a button. And most importantly, this is not just theory. Central banks around the world, the most sophisticated institutional players in global finance, have been buying gold at record levels for 3 consecutive years. They are not doing this because of emotion or headlines. They are doing it because they have arrived at the same structural conclusion Marco Mind is now explaining publicly. Beyond gold, Marco Mind repeatedly emphasizes true diversification, and he is very precise about what that actually means in this environment. It does not mean owning U.S. stocks along with U.S. bonds and assuming you are protected. Both of those assets are tied to the same currency and exposed to the same core monetary risks. Real diversification means meaningful exposure to assets across different currencies, different legal systems, and different drivers of value, so that one government's monetary decisions cannot damage everything you own at the same time. And there is one more point that matters deeply for anyone sitting mostly in cash right now. Cash held in a currency that is gradually losing value is not true safety. It looks safe, it feels safe, it shows no volatility, it does not produce frightening brokerage statements. But during a long, slow devaluation of the currency, which is exactly what tends to happen in the later stages of debt cycles, cash guarantees a quiet loss, not through a dramatic market crash, but through the steady erosion of what that money can actually buy over time. Now, before we close, there is one more piece of context that is genuinely important. Marco Mind has been laying out this framework since at least 2022, and although many of the trends he warned about have clearly unfolded, including accelerating debt, a sustained burst of inflation, record-breaking gold prices, and a sharp rise in geopolitical competition, we still have not seen a sudden and total systemic collapse. That matters, because the cycles Marco Mind describes do not play out on quarterly timelines. They do not resolve in a few months or even a few years. They unfold over decades. The fall of the Roman Empire was not one event. The British Empire did not lose global dominance overnight. That transition took generations. So the fact that everything has not catastrophically collapsed yet does not prove the framework is wrong. It likely means we are still somewhere in the earlier or middle stages of a transition that may take many years to fully play out. From a practical perspective, that means the goal is not to make reckless or dramatic changes to your financial life based on the belief that everything will fall apart next quarter. The real goal is to build a financial structure that is durable across multiple outcomes, one that performs reasonably well if we get a managed transition, but does not collapse if a disorderly decline begins instead. That structure will look different for each person depending on time horizon, current assets, income stability, and tolerance for risk. But the consistent message running through everything Marco Mind says is this: do not build your financial life entirely on the assumption that the current system will continue operating exactly as it has for the last several decades. Because history is crystal clear on one point: every system eventually changes. Every currency once believed to be unshakable eventually weakens. Every empire that dominated the world eventually gives way to the next order. Every single one. That does not automatically mean catastrophe for people who understand what is happening and prepare accordingly, but it can mean severe and lasting financial pain for those who assume nothing ever changes until the moment it already has. Here is the main point I want you to walk away with. Marco Mind is not saying the world is ending. He is saying the world is changing. And those are two very different things. The world changed after Rome fell. It changed after the British Empire declined. It changed after Bretton Woods in 1944. And it changed every single time one dominant order gave way to the next. And every single time, without exception, the people who understood the shift before it became front-page news came out the other side in a much stronger position than the people who did not. You have just watched this entire video. You now understand the big cycle framework, the debt math, the capital war already underway, and the 3 possible roads ahead. You understand more about what is happening in the global financial system right now than the vast majority of people who will be blindsided when the consequences of these decisions finally become visible to everyone. The only question now is what you choose to do with that knowledge. Subscribe, because this is exactly the kind of framework we break down on this channel. Every video goes deeper into the forces shaping the financial world and what they actually mean for real people making real decisions with real money. The next video dives into what the last 3 major economic transitions actually look like for ordinary people. Not governments, not central banks, real people trying to protect what they built. And it shows exactly what separated the people who came out of each transition stronger from the ones who did not. The pattern is always the same. Once you see it, you can never unsee it.